Welcome to How to Plan for Tax Efficiency in Retirement. Do you remember when you were a youngster and used to watch the Bugs Bunny Roadrunner show? Maybe you used to lounge around in your pajamas with the built-in feet on your shade carpeting? Well, I always remember there was an episode where the Wile E. Coyote was inside this shed concocting a bomb. Of course, the bomb was made by no other than Acme Bomb Company, while the Roadrunner was running around outside the shed. Hold that thought for just one moment. I need to ask you a question. Do you think taxes will be going up in the future or down? If you said up in the future, you and I are probably on the same page. So let me talk a little bit about our past U.S. tax history. So if we go all the way back to 1944, marginal rates actually reached 94%. Of course, in 1944, the U.S. had to pay for its wartime efforts. In 1944, if you're earning a couple $100,000 per year, then you were in the 94% bracket. And a famous movie actor by the name of Ronald Reagan used to be in that bracket. Supposedly, he would make 2 movies per year. He'd make the first movie and earn $100,000, make the second movie and earn $100,000, and then he'd just quit working for the year because it wouldn't make sense because all this money would go to the government. So during the 1940s and 50s, the top marginal rate was in the 90 percentile range. During the 1960s and 1970s, the top marginal rate actually was right around 70%, according to the U.S. Tax Policy Center. In 1982, no other than Ronald Reagan became our president. And one of his first actions was to reduce the top marginal rate all the way down to 50%. So now, during the 1990s and 2000s, the top marginal rate was actually right around 40%. And today, as you're going to see from our slides and the things I'm going to teach you, the top marginal rate is actually only 37%. So by 75-year standards, our rates today are somewhat lower than what they've been in the past. Now, one of the reasons why I think rates will be going up, in addition to the past history of our tax rates, is this thing called the U.S. debt clock. If you're fortunate enough, you might remember seeing this in New York City Times Square, or you can just look up online to see this debt clock. And the debt clock right now, our deficit is actually right around $25 trillion. And after the U.S. shut down with the coronavirus, supposedly that's going to be adding another $6 trillion to our national debt. Now, the 2 largest budget expenditures in our national debt are Social Security and Medicare, Medicaid. These 2 expenditures continue to go up because there's so many baby boomers that are reaching retirement age. By definition, a baby boomer would be somebody born between 1946 and 1964. So if you're in that age range, one of the first things you do when you retire is you apply for Social Security and your Medicare. Now, by the year 2030, 10 years from now, there's actually going to be 20% of our population that's in retirement drawing Social Security and Medicare and Medicaid. So again, we think that this national debt and national deficit will continue to go up. And the only way to make it go down, according to the comptroller for the United States government, is you have to do one of 2 things. One would be to reduce reduce spending by half, or number 2 would be to double taxes. Obviously, neither of those are very popular options with any of us, but the most likelihood is that they're going to be increasing taxes in the future. So our current tax laws actually expire December 31st of 2025, and we feel that the rates these days are fairly reasonable compared to past history and to where we think that they might need to go. So let's go back to our earlier story about Wile E. Coyote. He's in that shed concocting the bomb made by no other than Acme Bomb Company. And the Roadrunner takes that shed and pushes it onto these railroad tracks and Wile E. Coyote hears this train barreling down the tracks. And he looks in this little window and he sees the train coming. But instead of jumping out of the shed, what Wile E. Coyote does is he pulls down that little shade and goes back to work working on his little bomb. And of course, kapow! Onward to another Wile E. Coyote episode. But my main point here is this ticking time bomb that we have in our plans is things like our 401ks, IRAs, tax-deferred retirement plans that you've never paid tax on before. And in the future, what we think could happen is that it's almost like a little ticking time bomb for you. So throughout the workshop, we're going to try to encourage you to take action now in order to reduce your taxes into the future. So I have this laid out in a 5-step webinar lesson plan. And lesson number 1, we're going to talk about the current tax rate structure with ordinary income as well as with qualified dividends and long-term capital gains. So 2 separate brackets, and all of our decisions in the future are going to hinge on what our marginal tax rate is. So take good notes in this section, and again, we'll want to know what marginal rate we're in. Section 2, we're going to talk about our deductions and tax credits. And here I will teach you a few items that you could use in order to reduce your taxable income. Section 3, I'll be discussing the required minimum distributions. So this is where you'll accumulate money in your retirement accounts, tax deferred, and eventually the government is going to say, hey, we want you to pay tax on that money, and it could be at age 70 and a half, or for some of you, it might be age 72, according to the new Secure Act passed in 2020, which I'll talk about. Section number 4 will look at the taxation of your Social Security benefits. So oftentimes you go, okay, well, eventually I'm going to have this nice little paycheck coming in from the government, but a lot of times people don't realize their Social Security can be taxable if their provisional income is reaching certain thresholds. So we'll discuss that. And then section 5, we'll talk about retirement income planning strategies and tax mapping strategies in order for you to pull all these ideas and concepts together to get yourself into a lower bracket in the future. Something interesting I can tell you about myself is I've been a financial planner for 30 years and actively teaching workshops and webinars, and have literally had over 10,000 students that have come through my workshops. This has really helped me stay sharp and in tune with the current tax strategies as well as financial and investment management strategies. I'm also a certified financial planner, which gives me training in over 1,000 different integrated financial planning principles in order that I might bring a more comprehensive experience for my clients. Our investment company, Summit Investment Advisors, specializes in 5 different areas. We have financial planning, which is discovering needs, wants, and wishes of our clients and what tools and techniques are best to accomplish those goals. We specialize in retirement income planning, which is basically for pre-retirees and people that are already retired, answering questions, will I have enough? Will my money last? What investments do we draw from first? Should we take out of the IRA, 401k, Roth IRA, stocks, pensions, etc.? You get it. Investment management is our 3rd specialty, and here we are independent investment advisors. We're able to work with all the different investments, whether it's mutual funds, stocks, bonds, ETF, annuity type products. So we are licensed in those different areas, and we are fiduciaries, which means that we have to put our clients' best interests first. Of course, we have income tax planning, and there we do both tax preparation as well as forward tax planning. So there is a difference between the two. Let me describe them. Tax preparation is where you put your information in from last year to figure out if you're going to get money back or owe money in. Forward tax planning is using the tools and techniques and the steps I'm going to show you today in order to reduce our tax bill now and into the future. So we'll be looking out 3, 5, 10, 15 years now to increase our portfolio value as well as reduce our taxes. And then, of course, we have estate planning. And estate planning is once we built this money up, how do we pass it on to our loved ones without government interaction and government taxes? So those are our 5 specialties, which I'll talk a little bit about more towards the end of the workshop. We do have some post-webinar rewards, and so stick around because we have a special gift of bonus content. And the bonus content is going to be some of the charts and graphs that I'll go through during the workshop, along with some white papers that further describe the techniques, along with a flip book that's available for you on taxation and retirement planning. Second thing is we'll offer a no obligation phone or video web review. So oftentimes you're going to have questions as we go through the workshop. And this would be a good opportunity for you to talk with a certified financial planner and have those questions answered. Otherwise, we've provided some chat availability throughout this webinar where we'll have a certified financial planner helping you with the questions as they go along. And then the third thing is we have a complimentary roadmap to your summit plan and tax analysis. So those are our rewards at the conclusion of the workshop after you fill out the evaluation form. A disclaimer, and of course this is something that we have available on our website. And then now let's jump into step 1. So step 1 is understanding our tax brackets. This first area here would be our ordinary income tax brackets. And we have this progressive tax system where the more money you make, the higher your tax bracket is going to be. So if you're single and if your taxable income is $0 to $9,875, or if you're married filing joint and your taxable income is $0 to $19,750, you're in a 10% marginal tax bracket. Now, once you've exceeded the $9,800 for single or the $19,000 for married filing joint, all the way up for married filing joint to $80,250, you are in a 12% bracket. Once you go above those thresholds of $40,125 for single and $80,250 for joint, married filing joint, then you are now in a 22% bracket. So that's a 10% jump in your marginal tax rate. And then it just goes up from there. The news doesn't get any better. It goes from 22 to 24 to 32, 35, all the way to 37%, as I mentioned earlier in my intro. Now, 7 tax brackets. The more you make, the higher your tax is going to be. Here's a question for you, just so you can better understand how our progressive tax system works. Suppose you were at the top of the 12% ordinary income tax bracket and you earned $1 more such that you were now in the 22% bracket. Question is, what's the impact on your tax bill? A, my tax bill will go up substantially, or B, my tax bill will go up very little. Let me back up here and better define what I'm talking about. So let's suppose this married filing joint couple here has $80,250 of taxable income. So they're in a 12% bracket. And let's say that their employer says, hey, we're going to give you a $1 raise. And so now this year, your taxable income is going to be $80,251. And you go, I'm not so sure I want that $1 raise because now it's pushed me in the 22% bracket. So is that a good thing or a bad thing? Well, let's go back to our question here. If you think your tax bill would go up substantially versus going up very little, well, the answer is actually your tax bill will go up very little. So about half the people answer A, half answer B. And why that is, it's only that additional $1 that's now going to be taxed at the 22% rate. The first portion of our taxable income is at 10, then the next portion is at 12, and then the next portion is at 22. Now, where you find this information is look back at your federal tax return from the prior year. Look for that line item that says taxable income on the front page of your return, and that will tell you where you sit in this tax structure. It's the first thing you want to know because every decision that you make pivots on what marginal tax rate that you're actually in. So whether you're going to draw out of your IRA account, whether you're going to draw out of your Roth IRA account, whether you're going to draw Social Security, again, these marginal brackets are going to make a difference. Now there's another set of brackets, and that's going to be for capital gains and qualified dividends. They get a different tax treatment because what Congress has done is they said, okay, well, you're investing in a business and taking on risk, so we're going to give you a lower tax rate on the business income as well as the gains. So some of the businesses that you might be investing into, it could be real estate, it could be stock in a blue chip company, it could be investment type bonds. So there's many different types of investments out there. And how it works is they say, okay, if you have invested in something and it grows in value and you eventually sell that investment, as long as you've held it for a year, it qualifies for long-term capital gain tax treatment, which is at a lower rate. And I put this in a format of our tax map, which is a little bit easier way for you to see and visualize how the tax structure works. So as you'll notice here, this is for a married filing joint couple. They can take up to about $106,000 of long-term capital gain and still remain in the 0% tax bracket before they go into the 15% bracket. So that's a pretty good deal, 0%. Let me give you an example of how you might put that to work for yourself. I was recently working with a gentleman that came to our webinar, and he retired from a Fortune 500 company where they had corporate stock, they had a pension plan, a 401k plan, and in addition, he is eligible for Social Security benefits, and they had some stock purchase shares. So in his plan, what we recommended is that he would defer his Social Security, defer his pension, and the first couple years of retirement, he would start to sell that employer stock. And we actually forecasted he'd sell the stock over a 3-year period and realize about $106,000 of long-term capital gain each of the next 3 years. And it would all be at the 0% bracket. So it doesn't get any better than that. So he is properly planning of how to take distributions and income from his plan in the most tax efficient manner. That's forward tax planning. So with capital gains, a couple items here to pay attention to. Make sure you take advantage of the low rates each year. So if you have a capital gain that you could realize at a 0% tax bracket, go for it. Step that investment up. In years that we have a market downturn, you might look at selling those capital assets in order to do what we call tax loss harvesting, where you take a loss and you can use that loss to offset capital gain, or you can actually use that loss to offset up to $3,000 of ordinary income. Secondly, explore the NUA tax rules, and these net unrealized appreciation tax rules apply to individuals that might have employer-held stock inside their retirement plans at work. So this is an opportunity for you to be able to get that employer stock out of those plans and pay these lower capital gain tax rates. So it's a specialty item in itself. If that's of interest to you in the seminar evaluation, let us know that and I'll send you out some further information. Third thing here is hold dividend paying investments in non-qualified investment accounts. So oftentimes we see clients, they'll have their investment portfolio kind of flip-flopped where the dividend paying stocks are inside the retirement plan, and as those dividends are paid out, it's going to be taxed as ordinary income at those higher rates. Whereas if they're able to hold the stock inside a non-qualified retirement account, it would have the 0, 15, or 20% rate instead of the higher ordinary income tax rates. So take a look at your portfolios, and as you're accumulating and building, consider where you want to hold each type of investment. Okay, let's move on here to step 2, and that's understanding our deductions and tax credits. Our deductions are going to be a standard deduction or an itemized deduction. So the standard deduction, if you're married filing joint, is $24,800. And for single individuals, it's $12,400. In addition to that, if you're age 65 or blind, married filing joint, you get an additional $1,300 each, or if you're single, $1,650. Okay, that's our standard deduction. Most taxpayers, over 90% of taxpayers these days, are using a standard deduction on their tax return. If you can itemize by pulling together enough deductions, things like home mortgage interest, property taxes, charitable giving, medical expenses, you might have enough that in itemized deductions that you exceed these standard deductions. So if you can do so, that's a greater tax write-off for you. However, because of the new tax rules, what Congress did is they put a cap on how much we can deduct in state and local income taxes, so what we call our SALT tax. So a lot of people that live in higher income tax states are at a disadvantage these days because they're no longer able to itemize their state tax on their federal return. Now, my other point here is if you don't use them, you lose them. Now, what I mean here is I had a gentleman recently that attended one of our webinars, and he was having, he said that he's in a 0% bracket, and for the last 4 years, he hasn't paid any income taxes. We ran the tax mapping strategy for him, and we found that, yes, he was correct in that part of his tax preparation. However, he had more in standard deduction than he did in income. So he is actually in a negative tax bracket. What I figured out for him is that he could actually convert about $25,000 of his 401k, or excuse me, his IRA into a Roth IRA each year and still be in a 0% tax bracket. The advantage there to him is that once it's in the Roth IRA, it compounds and grows tax-free. And when he eventually takes it out of the Roth IRA, it's also tax-free. And so even though he is doing everything right with his tax preparation, he wasn't doing what we call the forward tax planning, and he missed out on the opportunity to do Roth conversions over the last 4 years. So he lost those standard deductions because you can't carry them forward. Those are our deductions. Let's talk about tax credits. So our tax credits are actually going to be a dollar for dollar offset against our taxable income. Some of the more common tax credits would be child dependent tax credit, education credits, and then the saver's tax credit. Most people that are probably watching this workshop are of retirement age, and so I want to talk about the saver's tax credit. In this example here, we have a couple that they have $40,000 of income coming in, and if you subtract their deductions because they're over age 65, it's about $27,000. And then from there, because they have some part-time seasonal work coming in or earned income coming in, they're still eligible to contribute to an IRA account. And in this case, they invested $2,000 into an IRA, and that brought their taxable income down to $11,000. Times the 10% tax rate brings them to $1,100 of taxes. Now they're eligible for the saver's tax credit because they put that $2,000 into the IRA account, and so the government gives them a $1,000 tax credit, which again is a dollar for dollar offset against the taxes due, and that brought their tax liability down to $100. So tax credits, very impactful. Keep in mind that you still may be eligible to do retirement account contributions. Okay, we're going to move on here now into step 3 of the presentation, and that's going to be how to understand the required minimum distributions. So the government eventually wants you to pay tax on the money that you've built up in these pre-tax tax-deferred plans like IRAs, 401ks, 403bs. When you have to start drawing the money out depends on your age 70 and a half or age 72. Now, to clarify how this works, if you turn 70 and a half prior to December 31st of 2019, you're going to be under the old rules. If you had not turned that age by then under the new Secure Act, you can start your RMDs at age 72. So how much do you need to take out every year? Well, you take a look at your prior year's ending account balance, and the IRS gives you this nifty chart that gives you a distribution period or a life expectancy. So if you're age 70, the distribution period is 27.4 years. Another way of looking at it is if you take 100 divided by 27.4, that would give you a percentage of 3.65%. So all in all, it's not a huge amount that you have to take out early on out of your retirement plan. It's just basically some of the interest or some of the growth. The older you get, the more you're going to have to take out. So when you're 90 years old, the distribution is going to be about 8% of your account balance. Now, question is, or here's another example of $500,000 IRA balance at age 70. So 500,000 divided by 27.4 equals $18,248 a year. So if you have $1 million in your retirement plan, it would be $36,000. If you have $100,000 in your retirement plan, it's going to be $3,650. So it just depends upon how much you've built up in these plans and how much impact it's going to have on your tax return at these ages. What happens if you don't take the required minimum distribution? Well, it's a very nasty tax penalty. The tax penalty is actually 50%. So it's 50% tax penalty plus the tax on the distribution plus the interest on the penalty. So be really careful not to miss your minimum distributions. And where we see this costly mistake happening is especially for people that have multiple accounts. Let me give you an example. So I have one of my longtime clients. His name is Mark, and Mark is age 60, and so he doesn't have to do required minimum distributions, but he's actually helping his mother, Mary, who is age 82. She's in the category that she has to do her distributions. Now, Mary actually has 7 accounts that she's doing distribution from. She has a 403b account where she used to work at a nonprofit. Her deceased husband, Mark's dad, actually had 2 401k accounts from corporations he used to work at. And in addition to that, Mary and her deceased husband each had 2 IRA accounts for a total of 4 IRA accounts. One was at a brokerage, one was at a bank. But anyway, 7 different accounts that she needs to do RMDs on. Now, if you can picture this, Mary has investment statements coming in every month from those 7 accounts. There's mutual fund statements, there's proxy statements, there's performance statements, and once a year in a nondescript envelope, she receives from the IRA company a question saying, hey, Mary, are you going to do a distribution from us or are you going to take care of it on your own? And if she doesn't respond and ask for the distribution, then it's a negative response letter, and so the IRA company is going to do nothing. So odds are pretty high eventually Mary's going to miss one of those distributions, have a huge tax penalty. And so what I recommended to Mark is I said, Mark, take those multiple accounts and put them into a self-directed IRA account, put them into one account. You can still own all your different investments that you enjoy having, the mutual funds, the ETFs, and so forth. Once they're in this account, it's going to be much easier for you to see and have online access on it so you can keep an eye on it in the event of senior fraud. You can make sure your mother is automating her required minimum distributions. And eventually Mark, I'd recommend that you have like power of attorney and become her personal contact on these investments. Mom was all for that. Actually, his mother, unfortunately, is going through dementia and has been, admitted into a long-term care facility, which I'll talk a little bit about later on how to protect those assets. But now, another thing that I'll say is that if Mary had 7 accounts and Mark has 2 sisters, you can imagine how many distributions that would be at Mary's passing. So that would be 21 distributions, because each of the 3 kids are splitting the 7 accounts. It becomes very complicated. If it's in one IRA account, well, it's only 3 different distributions. So what are the rules of inheriting an IRA? If it's a spouse that you're passing the money on to, then they get to keep it tax deferred and just do minimum distributions based on their life expectancy. If a child inherits the money, then they'll need to take that money out over a 10-year period under our new Secure Act tax laws. So you can't keep that money deferred forever. That's for IRAs, 401ks, Roth IRAs. And I wanted to mention that for those individuals that may have listed a trust as the beneficiary on their retirement account, you'll probably want to revisit that with whoever helped you set up that trust, or if you need help revisiting it, we do reviews of estate plans, because oftentimes that money will go into the trust, but now under the new regulations, it has to be distributed out over a 10-year period, and that might not have been what your original intent was. I want to bring up also this thing called the QCD. It's a qualified charitable distribution. So this is super important. If you're planning to gift money to charity, you can actually gift directly from the retirement account, and there's no tax to you and no tax to the charity. How this comes in handy is, let me give you an example. I have a client, his name is Rod. He's gifting about $5,000 a year to nonprofits, but Rod's standard deduction is higher than his itemized deduction. So he's not able to take a tax deduction for his charitable giving. So instead, what he's doing is he's having the IRA distribution go directly to the nonprofit, and therefore there's no tax to him and no tax to the charity. So QCD is a very powerful way of getting money onto charities. These are the new Secure Act regulations. So I've already talked about how some of those things have changed up. Let's move on to step 4 of the presentation, and that's the taxation of Social Security benefits. So this area here takes a lot of retirees by surprise. You may be receiving your Social Security benefit statements, and the government is saying, okay, we're going to give you $2,500 per month when you retire. And you go, okay, that's pretty good. And so you retire and you receive the $2,500 per month for a year, and you go to get your tax return done, and you notice that you have to pay about $4,000 of taxes on your Social Security benefits. And you go, well, what's that all about? Why do I have to pay tax on my Social Security benefits? Well, what happened here is you've exceeded certain thresholds based on your provisional income, which is adding half of your Social Security benefits plus ordinary income, dividends, capital gains, and non-taxable interest together. And if you're past these thresholds that you see here for single or married filing jointly, then your Social Security benefits all of a sudden become taxable. Let me illustrate this in an example. So this gentleman here is a single filer with $30,000 of Social Security coming in and has $36,000 from a pension coming in. Let's suppose he wants to take $1 out of his IRA or 401k plan that's never been taxed before. For $1 out of that plan, it would drag 85 cents of his Social Security benefit to become taxed. And so $1 out creates $1.85 of taxable income. In this example here, I'm illustrating a 30% tax rate, and the reason I'm doing that is, let's say that he has 22% federal tax and another 8% state tax. Well, 30% tax on that $1.85 it's 55 cents of taxes due on that dollar, which is an effective tax rate of 55%. So this is what we call the snowball effect in investment and income management. Here he thought, well, Social Security is not even taxable, but that Social Security is not only being taxed, but his investments, it seems like, are getting taxed at a much higher rate. We want to avoid this at all costs. I love this this joke here. It's, Daddy, what does IRS stand for? Income Redistribution Herald. All right, a little bit of humor into the workshop. I hear you laughing out there. Okay, let's move on here into an example of Social Security maximization. Oftentimes we get this question as to when is the most opportune time to draw Social Security benefits. And as you know, if you defer your benefits, they will compound upward past full retirement age all the way to age 70 at 8% per year, plus whatever the cost of living adjustment was. And oftentimes you'll go, okay, well, I'm going to defer my benefits as long as possible in order to get the most out of it. And you run these break-even calculations, and it's like, 17, 18 years out by deferring, you're ending up with more money. I think this is a very simplistic way of looking at things. I think what you also want to do is big picture planning to say, well, how much money do I have in my other investments? What other resources do I have? Because oftentimes, if you're not drawing Social Security, you're needing to use your own money. Here's a great example here of a couple. It's actually a case example. The names are Greg and Bev. And Greg retired from a large blue chip company, and his wife Bev actually was a school economist, not a home economics teacher, but she actually taught economics at a high school. And so she knew a lot about, Social Security, deferring, and so forth. Anyway, we ran this analysis for them in their roadmap to retirement plan, and they had about $1 million in a retirement plan at retirement. And so they're trying to decide if they should take 5% out of their retirement account, which amounts to $50,000 a year, and then draw one of the two Social Security checks, which would have been $20,000, because they needed about 70 grand of income coming in. The other way they can look at this is to say, okay, well, what if we took $20,000 from our IRA, less from their own money, but then started to draw both Social Security checks, or $50,000. This is what I refer to as my new car slide. And why I call it my new car slide is because there's such a dramatic difference in amount of money that they have to pay in tax in this example. So if they took 50 grand out of the IRA and one Social Security check, their federal income tax is $4,415 a year. If they take only $20,000 out of their IRA and $50,000 from Social Security, now their federal tax has actually gone down to zero. So the $4,415 a year, that could easily cover car payments for a full year. That's why I call it my new car slide. So in Greg and Bev's example, they thought it was best to draw both their Social Security checks and leave their own money deferred and compounding as long as possible. Everybody's situation is unique. Again, that's why in the end of the workshop, we have some bonus content as well as some complimentary offerings that can help you figure these things out for yourself. Okay, let's move on to step 5. You probably recognize this gentleman here. Of course, it's Albert Einstein. And Albert was probably one of the smartest men ever to walk the face of this earth. And Albert was a professor at Princeton University. He taught there for about 20 years. And funny story is, during the 3rd semester, his fellow professors came up to him. They said, Albert, you have to change things up a little. And he said, what do you mean change things up? And they said, you've given the same final exam questions for 3 semesters in a row here, and these kids are smart. They already know what your questions are going to be. Albert thought about it a little bit, and he actually responded. He said, I'm not going to change the questions up because the answers keep on changing. Isn't that the truth? It's just like life today, with our answers keep on changing. The tax rules and regulations change all the time. So I, congratulate you because you're, participating in this webinar, learning about the new tax laws and regulations. The investment markets change all the time. We can have a growth market, we can have a bear market, we can have a recession, depression, whatever it might be. Those things keep on changing. Now, the other couple of things that were kind of fun about facts about Albert Einstein, somebody asked him, what he thought the most difficult problem to solve was, and he said the income tax code. So even somebody very smart couldn't figure that out. They asked him what he thought the eighth wonder of the world was, and he stood in his tracks and he said compound interest. So I'll actually bring in one of those examples as I go through the rest of these slides. And the fourth thing that was quite profound that he said is that the mind that got you into this problem isn't the same mind that can get you out of the problem. So what does that mean? Well, it means that oftentimes we need collaboration or a different viewpoint or a professional to help us with our situation. So I'm going to tie a little bit of that into our step 5 of the presentation. And that's going to be retirement goals planning and tax mapping strategy. Where you begin with all of this, we always want to start with our goals in mind. Everybody's situation is going to be unique in that area. If your goal is to be in a 0% tax bracket, well, that's simple to solve. I'll just say, okay, well, take nothing out of your retirement accounts and just draw your Social Security. Voila, you're in a 0%. Well, you might say, well, that's not quite what we had in mind for goals. Of course, we're going to want to do some things with our money, and we need to establish those goals early on. Retirement income planning, that's going to be pulling all our assets together and figuring out the best strategy, along with our tax reduction strategy. And our risk management strategy is important also. How do you protect these assets long term? Now, I like to, I'll go through a case example here of a couple. Their name are Jack and Sue, and I've known them for quite a few years. And actually, Jack and Sue, they update their retirement plan and tax map on a yearly basis. So here's what they had for, actually in 2019, last year, their needs, wants, and wishes. That's how we break it out. The needs, quite simply, would be your day-to-day living expenditures, hang out at home, food, clothing, shelter type of thing. And their need category was a car this year, but oftentimes we think a car is more of a want, where you can vary the timing behind it and the amount you spend. So a car could be anything from $30,000 to $150,000. It could be something that you might be able to get a few more miles on your other car. So it's more of a want, in my opinion, but because they waited so long, it's a need in their case. And then you have the wishes. The wishes would be things that you'd really like to do if there's enough money. So Jack and Sue, they need to have $48,000 a year, $4,000 a month spendable income. They need to have a car this year, which is $30,000. They want to do home improvements of $25,000, a kitchen remodel. Their wishes are to do a Hawaiian trip on their 50th wedding anniversary, and they've always wanted to have an RV to travel the national parks. So what we do is we say, okay, well, let's figure out the most tax efficient way of getting this money out of your plan. And as you know, our Social Security benefits, they have $48,000 a year coming in Social Security benefits. And by itself, Social Security benefit is not taxable. Zero due on that. Okay, that makes sense. Provisional income doesn't exceed those thresholds. Next, we say, okay, you have your Social Security coming in, $48,000. What if we took $1,000 a month out of your IRA, and then this year realized a $20,000 long-term capital gain on some stock that Jack and Sue have owned for a long time. So going back to the tax map strategy, what we found is the $80,000 of income they're now pulling in to cover their needs, wants, and wishes. There's only $121 of federal tax due on that. That's some very efficient tax planning for this couple. So, in addition to that, here's a sample plan of a gentleman that was approaching retirement, and he retired from the state. So he had a pension availability along with Social Security and some deferred resources. So what we did here is we use our planning program to first figure out if he's going to have enough. And the projection was that he has a 99% probability of success, that he has plenty of money built up for his future. After testing the heck out of the plan, what the result was is at age 90, based on what he has available and his income needs, he'd actually have $1.7 million compounded out in value at that point in time, which in today's dollars is actually about $946,000. So his situation, he's going to have plenty of money for retirement. But then what we did next step is we said, okay, well, what can you do to better the plan? And his decisions were, okay, well, when should I draw Social Security, and should I do retirement plan conversions into a Roth IRA? So we took it another step and we said, okay, well, what if you started your Social Security at age 64, but between now and then you did Roth IRA conversions? And without changing the rate of return on his investments, now he's improved his plan from $1.725 million to $2.24 million. So he's improved his plan by a $500,000 amount. That's pretty good. And plus, it's an additional amount that would go tax-free to his heirs in those Roth IRAs. From there, we said, okay, well, let's do another scenario. And we said, if he were to defer Social Security all the way to age 70 and do as much in Roth IRA conversions each year as possible, well, now it's improved his plan all the way up to $2,390,000, which is a $700,000 jump in the amount of money that he has in the future. So going back to Albert Einstein's example, compound interest really adds up. And when you combine it with forward tax planning, what you're doing in essence here is you're reducing your biggest expense that you have in your retirement plan. And that's the government standing there every year and saying that they want 30% of your net worth. So take advantage of the roadmap to your retirement plan and the tax mapping strategies, which are going to be available to you complimentary at the end of the workshop. You probably recognize this mountain. This is Mount Everest. It's one of the highest and most difficult mountains in this world to climb. I don't know if it's on your wishes list to climb Mount Everest or even trek Mount Everest, but it's a very difficult endeavor that you'd probably want to have a lot of planning and expertise in order to do so. So when you're approaching retirement and headed toward that summit of retirement, it's a whole different skill set building up and saving and putting away money pre-tax into your retirement plans than it is drawing out of those income plans. So throughout your life, you're going to have many different peaks, you're going to have many different summits, but once you've summited at retirement, it's going to be a whole different ball game in figuring out what to do next. Interestingly enough, on Mount Everest, where do most climbers die on Mount Everest? Is it ascending the mountain or descending the mountain? The answer is actually descending the mountain, believe it or not. Wouldn't you think it's simpler to go down a mountain than up a mountain? Well, I guess from what I hear, there's different things that can happen when you're descending the mountain. One might be that you run out of oxygen, and that could be a similar thing to like the IRS kind of choking the taxes out of you throughout your retirement years. Or it might be a snowstorm or avalanche or some crazy weather pattern hits. And that today would equate to a bear market where the stock market goes down 35%, which we just saw with the coronavirus outbreak. Could be a recession, it could be a depression. So how do you survive catastrophic black swan events like that? Or maybe it's darkness sets in. You just didn't summit and peak soon enough. And so every step that that climber takes, they're at risk of not seeing where they're going. And that, to us could be, things like you reach retirement and there's inclement health conditions that, where you're at risk and you don't know how to handle these types of things. So going back to the Albert Einstein, oftentimes we want to collaborate with other minds in order that we can improve upon our journey. And so our investment company called Summit Investment Advisors is where the brightest of goals meet the brightest of minds. So I hope I've demonstrated some of my expertise today so that you would want a real expert to help you with your journey. In summary, we've covered 5 different steps to the planning process. We talked about the tax brackets, ordinary tax brackets, as well as qualified dividends and capital gains. We've looked at the deductions and tax credits as a way of reducing your taxable income. RMDs, we talked about Social Security taxation. From there, we looked at tax mapping and investment and income planning opportunities. Now, if you would be kind enough to fill out the evaluation form, which you can see on the side of your screen, click on that, and then that'll make you eligible where we'll send out these bonus opportunities for you. We're going to send a special gift of bonus content, and that's going to be the different tax charts that we covered today, along with any white papers that you want further in-depth studies into. In addition to that, we're going to send you the link for a flip book to help with your retirement income planning needs. Second thing here would be a no obligation review of your plan over the phone or by video conference. That's going to be with a certified financial planner who can answer any detailed questions that you might have about your specific situation. Again, no obligation to that. Third thing here would be a complimentary roadmap to your retirement plan and tax analysis. So if you have not updated your plan or would like a second opinion or haven't had a plan done at all, take us up on that, and we'll help walk you right through it over the phone and by video web conference. So thank you again for attending, and once again, feel free to reach out to us with any questions.